Let's bring in here Stephen Miller, market strategist with GSFM Funds Management. Stephen, this is really fascinating because you can see the way in which Trump's tariffs are changing things around the world. One thing as we go to where is I notice the Indian stock market well down because they haven't been able to negotiate less than a 25% tariff. You can see what happened to copper in the United States. You can see even what's happened to the Ford Motor Company, right? So it's every small bit that's affected by Trump, his policies, tariffs, including even the US Federal Reserve.
Yep, it's upending markets, that's for sure. I think what Jerome Powell's sort of getting at by maintaining the policy rate where it is as opposed to cutting it is he's got a problem. He's got a balancing act he's got to sort of manage. Because what tariffs do is they diminish activity growth in the end and they also raise prices. What Jerome Powell's trying to do is trying to quarantine that price impact from getting into expectations and becoming self-fulfilling. So that's why he's keeping policy rates steady and not cutting them. And he reckons if he can anchor inflation expectations, if and when the economy starts to slow, that'll be the time when he'll start thinking about cutting rates. And bear in mind the last dot plot we got from the Fed did say that there'd be two rate cuts this year.
Yes.
So, you know, whilst Jerome Powell was reluctant to endorse a rate cut in September, that doesn't mean there won't be one. We've got a few data points to go between now and the September meeting. 2 key inflation prints, 2 key payroll prints. I think the Fed will look at those and then they'll make a decision when it comes to September.
OK, but then it's much harder to cut interest rates when the US economy is growing at 3%. Now, remember that Australia's long-term average for economic growth is 3% per year, give or take. Right now, Australia's economy on an annualised basis is growing at 0.8%. Now, the fact is they're growing. So our interest rates are basically being justified right now because of our weaker economy.
I'll make 2 comments about that one. The 3% growth, yes, it's very impressive. And I'd say in general, the economy in the US has been better performed in the wake of these tariff increases than we may have thought. Now, does that mean that'll continue? I don't think so. Remember, that 3% growth rate for Q2 in the US came after a minus in the first quarter because there was a bit of switching happening because households spent ahead of the tariffs coming in. So you might sort of think that GDP in the second quarter was perhaps artificially inflated. So
what you're saying is if prices do go up, all of that could come off pretty quickly.
Yeah, exactly. That's the first thing. There's a bit of growth front-end loaded, if you like, into Q2. The second thing I think in Australia, and this is where Michelle Bullock has probably got a bit of an advantage over Jerome Powell. I talked about Jerome Powell having to balance this tricky mandate. You know, he's got a circumstance where the labour market might be slowing and inflation is sticky. At least in Australia, with those numbers that we got yesterday, we're getting inflation close to the middle of the target band. That makes a rate cut in August near enough to a virtual certainty.
And as I said, the market's now priced in 2 this year, and probably there's at least another 1 or even 2 next year as well.
Because I think what Michelle Bullock will have to do is she'll have to contend with a weakening labour market. You mentioned private sector spending here has been quite weak. What's held up the labour market has been, you know, growth and employment in the non-market sector, public administration, health,
in other words, government-related
services. The market sector employment growth has been pretty tepid. Now, we think that public demand or public spending is about to sort of go into a bit of a hiatus, which means that growth in that non-market sector will start to decline. And at the moment, activity growth in the private sector doesn't seem enough to pick up the slack. So what that means is now that inflation looks as though it's headed toward the centre of the band, I think Michelle Bullock now has to maybe sort of press the accelerator a little on rate cuts because she might have to pay more attention to the employment side of her mandate now that the inflation side looks to be under some control. And that's not the circumstance.
But the impact of that is that they would stimulate the housing market. It could stimulate building. And so as a result, it could actually stimulate the non-government related side of our economy, which has been sound asleep for the past 2 or 3 years.
And that would be, that's precisely what should be happening. That if there is going to be weakness in the labour market, if inflation... but these are big ifs. If inflation stays near the middle of the band, I think the RBA has a few more degrees of freedom than the Fed in cutting rates to support the private sector labour market than, say, it may have perceived when inflation was at or near the top of that band.
I'll tell you what, it's always good to have in the program because the other thing as well is that economic roundtable, and if the government can get out of the way of business, maybe it will get itself on as well.
I think that's very important because productivity is the biggest wart on Australian economic performance that currently is around.
I've got to leave it there, Stephen. Many thanks for your time.